क्या आप टर्म इंश्योरेंस लेने वाले हैं? तो अगर लेने वाले हैं, तो ये वीडियो देखे बिना आप मत लीजिएगा। So if you're planning to buy a term insurance, please don't buy it before you watch this video. So in today's video, I'll talk about how you can lose up to 25 lakh rupees by taking a wrong decision of paying up your premium in a limited pay option. Okay. So if I talk about the term insurance, there are lots of truth about term insurance. Like while I agree, I do not disagree on the fact that term insurance is indeed an important insurance product. Okay, and everyone should have at least a term insurance plan, if not any other insurance plan. Okay, for the financial well-being of your family or dependents. Okay, but what do I disagree is that the culture, the payment tradition which is going on now. Okay, and if you ever have thought of buying a term insurance, you would have seen there are two ways to make up a payment. Okay, one is the limited pay option where the broker or the consultant, or even if you're buying it through a third party aggregators, they will also try to influence you to opt for it. Okay, so instead of, let's say if you're buying a term insurance of like 30 years, okay, they'll tell you like instead of paying up for 30 years, you only pay for like 5 years, 10 years, 15 years. Okay, that's a limited pay, so you pay for a limited premium. Okay, and next is the regular pay, which is like a common regular pay premium, which you pay for the entire term of your policy. Like if you have a 30 years coverage, you pay for 30 years. Okay. So that's what we talk about in detail today. Why you should not opt for a limited pay. What will you lose if you opt for a limited pay? And is there actually a way, actually a circumstance where you can opt for a limited pay? Okay. So today's highlight, we'll talk about a little bit on term insurance. I'll not too much put emphasis on this topic, as you may all know about term insurance in general. And I'll say like what not to buy and why not to buy a term insurance with what option and what is the right way to buy it. Okay. So first, a small just an highlight on term insurance. It's basically a type of an insurance policy or a plan product, you can say, where you pay up a little premium compared to the amount of sum assured. Okay. And generally, this only covers your death benefit. There is no return of premium or a maturity benefit in a term insurance. Ideally, that was not supposed to be any other benefit apart from death benefit. But now, with all due to a marketing and the way of influencing multiple segments of people, they're coming up lot many options like return of premium, or in certain cases you also see like 2x return of premium. Okay, so all that is coming up now slowly and gradually. So it's a very basic term insurance, life insurance product. Everyone should have it. Like in a general, if you go and buy your endowment plan or a term or a ULIP plan, you'll only get like 10x of the summation of the premium you pay. Like if you're paying a lakh rupees per annum, the maximum insurance coverage you will get is for like 10 lakh rupees. Okay. Same goes for endowment also. It's 10x, not more than that. But in case of the term insurance, you can actually get a crores of sum assured with a premium of let's say like 10,000 only. Okay. So I have my own term insurance from one of the company, and then it's a 1 crore term insurance. I only pay like 9712 something like that. That's it. I took it quite a long back when I was like in 2016, 17. I took that policy. But still, I'm just telling you the difference in the premium. And if for the similar amount, if you have to buy a ULIP or any other policy product, then you have to pay at least 10 lakh rupees as a premium, which is a huge 10,000, 10 lakhs. Is way. Okay, so that's what basically a term insurance is. Now, the next, going to brief you on why term insurance and what's the difference between a limited pay and a regular pay. So if you look at this first screenshot, okay, this is I took it from the aggregator's website, and there are two different companies over here. I don't want to get into a trouble by calling out those company names and the aggregator name. I'm just giving you a reference. You can all do this calculation by yourself. Nothing is like secret over here. So I opted for a minimum 1 crore of sum assured, and I asked them for a coverage till 60 years of my age. Okay, and the first company showed me a premium of 9767 per annum. This is a premium which I have to pay. Okay. And the second company showed me for a similar thing, some 11,834. Not sure why they are charging me 2,000 rupees extra, but depend upon company to company. Maybe they are 0.4% extra higher on the claim settlement. Could be a reason, I don't know. But okay, that's okay. So this is what the premium is if you buy a term insurance plan in a regular premium paying frequency. On the flip side, if you look at the other one, right? If you look at the other one, this is the limited one. Limited per one straight away increases your premium from 9,767 to 22,880 rupees. So almost like 250, 250%, right? Or 2.5, like 10,000, 25,000. You can say that. 11, 12,000, 26,000. Okay. So that's how the difference is. Now, एक बार तो you will feel like, okay, fine. So I have to pay just 10,000 rupees for 30 years. And here I'm only paying 25,000 rupees for 10 years. And that's like 2.5 lakh rupees. And here I'm paying 3 lakh rupees. So you're like, okay, I'm saving like 50,000 rupees. Okay, right? So if you pay 10,000 rupees per year for 30 years, like 3 lakh rupees you will pay. And here you're only paying like 20,000 rupees for 10 years, like 2.5 lakh rupees, right? So at first you will see like, okay, I'm a saving of 50,000 rupees. And that's how people call it out. People, when they say the 136% saving, 26% saving, this is what the saving is for them. Okay. But what you're missing is the opportunity cost. Okay. So opportunity uh, cost is basically the value which you will be able to create for yourself if you invest that extra money into some other sort of investment like FD, mutual fund, or bond, index fund, anything. So here's an example. Okay, so if you so that extra 15,000 rupees which you are paying it to the insurance company for a limited pay, let's say if you put that money into a mutual fund, okay, any mutual fund, equity, debt, index, any mutual fund, if you put that money, and if you leave that money, and if you pay that money for 10 years, because 10 years you were supposed to pay that 25,000 rupees, only for 10 years, you pay that 15,000 rupees to a mutual fund company or to buy a mutual fund. Okay. And you wait for 30 years because 30 years you're supposed to cover yourself and you wait for 30 years. So even with a smallest of smallest rate of return are like 8%. Okay, if in a minimum 8% return also, which is 8% is very basic for a mutual fund to give because generally 7% you usually get in the FDs. Okay, 8% is nothing for a mutual fund to give you. Okay, in the long run. And here we are talking about 30 years. So even with a minimum 8% return, if I look at, you will be able to generate 10 lakh rupees for yourself. So that 15,000 rupees, instead of paying it to a insurance company, if you put that money into a mutual fund for 10 years and wait for 30 years, your money will become 10 lakh rupees. Now remember, you were paying 2.5 lakh rupees overall to the insurance company. Okay. I'm telling you, you don't pay that money extra over there because see, well, you were paying 10 lakh rupees, 10,000 rupees. Against 10,000 rupees, now you're paying 20,000 rupees. That 15,000 rupees, instead of paying it to a company, you just invest into a mutual funds. That will give you 10 lakh rupees of value. 4x of what the total you will end up paying to them. That's the money you will earn. If I increase, since it's a long-term investment, if I increase the rate of return to 10%, this will go up to 16 lakh rupees. And if for 12%, which is a nominal for equity mutual fund to give you, this will be huge 25.4 lakh rupees. Okay. So understand this is the opportunity cost you will miss out if you decide to pay that extra premium in the initial 10 years or the first 10 years, 5 years. Okay. So my suggestion, you only go for the regular pay. Okay. Do not go for a limited pay unless you have these kind of situations. Okay. So you have like a huge lump sum money and you don't mind paying that extra 10,000, 15,000 rupees. Uh, there's enough cash at the back of yours and then you don't mind doing that. So you can do it. If you want a zero obligations in your life, like you want to get rid of all those premiums, CMIs, everything as soon as possible, then you can opt for a limited pay option. Okay. Or if your income is unstable, you are into a profession like maybe a cricketer, maybe a actor, maybe a artist, maybe something which is not so much stable, where the income is not so much fixed. You don't have that fixed income, or you don't have that of foresight. कि भाई next year I'll be earning like 10,000 rupees, 15,000 rupees per month, whatever. So if that sort of situation is there, then obviously you can go for a limited payer. Okay. But if the situation is not this one, then it's not required. Go for regular pay, pay like 10,000 rupees per year for rest of your life for 30 years, like whatever the period you're getting cover for, and be peaceful. If you have that extra potential to pay as a premium, use that money to invest into a mutual funds, FD, bond, wherever you feel right, wherever you feel this matches this profile. I made a video on this profile last time. It's there in my channel. Please go ahead and watch it. It's very in detail, in depth. And if you just do it, if you spend your half an hour in doing that, watching that video and doing that, which I have explained in that video, you'll be secured for the rest of your life. Okay. So in a nutshell, if I have to talk about limited means like if you weight lifting heavy, you heavy weight lifting earlier, and then you move on to the relaxing stage later on. And regular pay is like you lift it light and then have a peace of mind on. Okay. So this is in more detail, like comparing it what limited pay and the regular pay are, and it's all different aspects. So limited pay, when we look at is like you pay for a limited premium period, 5 years, 7 years, 10 years. So all these options have been given it to you. Okay. While if you say a regular pay, it means you pay end up paying like 30, 40, 15, 20 years, whatever the coverage period is for you. Annual premium for a limited pay is much higher, at least 2.5 x. We have seen that pass, and it's very much lower and manageable in the regular pay. If I talk about the total premium paid, is would be a little bit lesser than the regular pay, but just by doing a simple calculation of plus. Okay, if you do it the way I have shown you, looking at the opportunity cost, then it's a loss. Then it's a loss for you. Cash flow impact, obviously, because you have to pay a heavy premium initial days. So initially you will be stressed. Uh, let's suppose someone buying a 2 crores of sum assured, they may have to end up paying like 45, 50,000 rupees also as a premium for first 5, 10 years. So that's a huge. Okay. So regular pay, it's a light model that's 9,000, 10,000 rupees for a crore of insurance, and you're sorted. Okay. Opportunity cost I explained before. There's a large amount required to be paid in the initial 10 years, 5 years. So obviously there's a loss to an opportunity value over there. You will lose on the profits you will be end up making by investing that much of surplus into a equity or a mutual fund or any other stock share extra. And there's no as such an opportunity cost loss in the regular pay. Flexibility, obviously, there's no flexibility as such in a limited pay because once you offer a limited pay, you have to follow to it. You don't have an option to change it later on. Okay, you're committed to it. But in a regular pay, there's a flexibility. Not much in terms of a premium or in a term, but it's a small amount. You can still have you can manage your finances accordingly. Yeah. Some more suitability. If I talk about for a high stable income, people who want a stress-free life ahead, don't want liabilities of paying up a premium at the age of 60 or less than that. So suitable for them. Regular pay is much more suitable for people who want little stress on their life, who understands the finance better, and those who have a knowledge on how to bring value to their investments. So even if it is rupees 100, I should be looking at how to make that 100 into 150. Okay, rather than paying that 100 rupees in exchange of some low interest liability or especially to check off my liability at the later stage. I won't do that. I'll try to make value for that 100 rupees also. So if obviously there's a risk, a high risk in limited pay if your income drops all of a sudden, then you have a risk of losing on that insurance because you are paying a higher premium. The risk is lower in regular pay because amount is lower. So all these are benefits. The tax benefit is there in both regular limited pay and regular pay. It's just a matter of fact, regular pay you will have the benefits going on for a longer period, whereas in limited pay end up the benefit would be only for the time you are paying that. Okay, and if the premium is more than the available limit, then also you're losing out of that benefit. So that's pretty much about the limited pay. That's pretty much which I want to talk about today. A very short, crisp video. I make videos on finance. I made videos on credit cards as well. All there in my channel. Please go through it. Understand, guys? All these videos are free of cost. This is the experience which I'm sharing with all of you for last 10 years. Okay. So please do subscribe to me if you find it worth. And thank you so much for your time.